Hello and welcome to our channel. In today's video, we're going to dive deep into a classic yet powerful strategic tool that has helped countless companies manage their product portfolios effectively, the BCG Matrix. Developed by the Boston Consulting Group in the 1970s, the BCG Matrix, also known as the Growth Share Matrix, is still widely used today. But what exactly is the BCG Matrix? How can it help businesses make strategic decisions? And what does it look like in real-world scenarios? We'll answer all these questions and more, so stick around till the end. First, what is the BCG Matrix? In a competitive business environment, companies often have a wide range of products, each at different stages of their life cycle. Some products are growing rapidly, others are stable, and some are in decline. The BCG Matrix helps companies figure out where to invest their resources, which products to develop, and which ones to phase out. Before we dive into the details, let's take a quick look at the origin and assumptions behind the BCG Matrix. As we mentioned earlier, the BCG Matrix was created by Bruce Henderson, the founder of the Boston Consulting Group, in 1970. It was designed to provide a simple, visual framework for companies to evaluate their business units and products, allowing them to allocate resources more effectively. The matrix is built on a few key assumptions. Market share equals profitability. It assumes that products with a higher market share generate more profit due to economies of scale. Market growth indicates investment needs. High-growth markets require more investment to maintain or grow market share, while low-growth markets require less investment. Lifecycle stage. The matrix is based on the product lifecycle concept, where products move through stages of introduction, growth, maturity, and decline. Strategic focus. The tool assumes that companies should focus on products that offer the highest returns or have the potential to do so. Second, 4 quadrants of the BCG Matrix. Now let's dive into the heart of the BCG Matrix, the 4 quadrants. The matrix is designed to help businesses prioritize their investments by categorizing their products or business units into 4 distinct groups based on 2 factors: market growth rate and relative market share. Market growth rate. This refers to the rate at which the market for a product is expanding. A high market growth rate indicates a rapidly growing market, while a low market growth rate suggests a mature or declining market. Relative market share. This is a measure of a product's market share relative to its largest competitor. A high relative market share means the product is a market leader, while a low share indicates it's a smaller player. By analyzing these 2 dimensions, the BCG Matrix helps companies determine where to invest, which products to develop, and which to phase out. The 4 categories or quadrants of the BCG Matrix are stars, cash cows, question marks, and dogs, each representing a different type of product or business unit. First, stars. High market growth, high market share. Stars are leaders in rapidly growing markets. They require significant investment to maintain or increase their market share. Although they may not generate substantial profits immediately, they have the potential to become cash cows as the market matures. Strategy. Invest to maintain or grow market position. Focus on maximizing market share. For example, a leading smartphone in a rapidly growing market segment. Second, cash cows. Low market growth rate, high relative market share. Cash cows are well-established and profitable products or units in a mature market. They generate consistent cash flow with little need for investment, making them crucial for funding other parts of the business, such as stars or question marks. Strategy. Harvest profits and invest minimal resources. Use the cash generated to support other business areas. For example, a well-established beverage like Coca-Cola in the soft drink market. Third, question marks or problem children. High market growth rate, low relative market share. Question marks operate in high-growth markets but have a small market share. They require significant investment to increase market share, but the outcome is uncertain. They could either become stars or fail and turn into dogs. Strategy. Invest selectively. Assess whether it is worth investing to increase market share or consider divesting if the prospects are poor. For example, a new tech gadget in a fast-growing market but with low initial market penetration. Fourth, dogs. Low market growth rate, low relative market share. Dogs have weak positions in low-growth markets. They generate little profit and may even drain resources. Unless they serve a strategic purpose, they are often candidates for divestment. Strategy: divest or discontinue unless they support other aspects of the business. For example, an outdated software product in a declining market. Third, how to use the BCG Matrix. Now that we've covered the 4 quadrants of the BCG Matrix, let's talk about how businesses can use this tool to make strategic decisions. Step 1. Assess the portfolio. The first step is to assess your entire product portfolio. List all the products or business units within your company and gather data on each product's market growth rate and relative market share. Step 2. Plot your products on the matrix. Next, plot each product or business unit on the BCG matrix based on its market growth rate and relative market share. This will help you visualize which category each product falls into. Step 3. Analyze the matrix. Once your products are plotted, analyze their positions. Stars will require continued investment. Cash cows should be harvested for cash. Question marks need careful evaluation, and dogs might need to be divested. Step 4. Make strategic decisions. Based on your analysis, decide where to allocate resources. Invest in stars and promising question marks. Milk cash cows for profit and consider divesting or phasing out dogs. Step 5. Regularly review your portfolio. The market is constantly changing, so it's essential to regularly review your portfolio and update the BCG matrix. This will help you stay agile and make informed decisions as market conditions evolve. Fourth, real-world applications and case studies. Let's take a closer look at some real-world applications of the BCG matrix and how companies have used it to shape their strategies. 1. Let's consider Apple Inc. or STARS, the iPhone, which dominates the high-growth smartphone market. Cash cows, the MacBook, which has a significant market share in the mature laptop market. Question marks, Apple TV Plus, which is in a high-growth streaming market, but has a smaller share compared to giants like Netflix. Dogs, the iPod, which is in a declining market with very low sales and market share. The BCG matrix helps Apple decide where to invest, develop, or divest, contributing to its overall strategy. 2. Google, Alphabet Inc. Google's core business, search advertising, is a cash cow, generating the majority of the company's revenue in a mature market. However, Google has invested in several question marks like its self-driving car project, Waymo. The autonomous vehicle market is expected to grow rapidly, but Google currently has a small share compared to competitors. Whether Waymo becomes a star or remains a question mark will depend on Google's ability to scale the technology and capture market share. Fifth, profitability, losses, and strategic needs. So which products are profitable, which are making losses, and which ones need more work according to the BCG matrix? Profitable products. Cash cows are the most profitable products in a company's portfolio. These products are essential for funding other areas of the business, especially stars and question marks. Loss-making products. Dogs are typically the least profitable products, often making losses or generating minimal cash flow. Products needing work. Question marks are products that need careful evaluation and strategic investment. While they have the potential to become stars, they also carry the risk of becoming dogs if not managed properly. Long-term investment. Stars are not always immediately profitable, but are critical for long-term growth. And there you have it, a comprehensive answers of all the questions of the BCG matrix. It's a timeless tool that has helped businesses across the globe manage their product portfolios strategically. By categorizing products into stars, cash cows, question marks, and dogs, companies can allocate resources effectively, maximize profitability, and ensure long-term success. If you found this video helpful, don't forget to give it a thumbs up, share it with your network, and subscribe to our channel for more business and marketing insights. Let us know in the comments which product in your portfolio you think is a star or a cash cow. Thanks for watching. See you in the next video.